Hello everyone, Jamie Hopkins here, Managing Partner at Carson Group. And I want to talk about the Secure 2.0 Act and do a quick overview here with you of the main provisions I see that could be impacting you and your retirement planning in the next couple years. So look, this is part of the 2022 Omnibus Bill, which is putting together a bunch of bills really to get government funding going for next year. So defense funding, all of those things are packed into this. And we have over 100 retirement provisions in here in this bill. It's a big deal. So there's a lot to unpack. And I'm going to do my best to do it here concisely and quickly. So let's start with expanded savings opportunities that are inside of this bill. So number one, there's a starter 401k or 403b plan, which is super simple, really easy to set up, really easy to use, which is following the IRA contribution limits and just allowing for employee contributions. So no employer contributions, super simple plan to set up, help people get up and start saving. A de minimis benefit, so think about gift cards to hand out to get people to enroll in the qualified plan. That used to be prohibited under ERISA. This would now make it possible. The Savers Credit, which has been around for a long time, up to $2,000 where the government will match 50% of that. In the past, this was a non-refundable credit that you had to really file for during tax season. This would actually become a match and go into an IRA or qualified plan. There's an automatic enrollment and escalation provision that would require new plans in the future to start with automatic enrollment and escalation, starting somewhere between 3 and 10% that goes into the plan and increasing by 1% a year up to a max of 15%. So it can't go up above that with these provisions. Then at the bottom one here, expanding some small business startup credits. In the first 3 years of a plan, there was a credit for 50% of administration costs and setup fees, up to $5,000. This is now increasing that for employers with 50 or fewer people, up to 100% of those costs, but still with that $5,000 cap. So that is part one. So let's continue on here. RMD changes, a lot of required minimum distribution changes. Number one, lifetime income aggregation rules. So this would be if you annuitized an annuity. And inside of that IRA, you then had to separate that annuitized annuity out, calculate the RMDs around that separately from the remaining parts of the IRA. In some cases, this required based off the income from the annuity and the income you had to pull from the rest of the IRA more than what would be required under a traditional RMD calculation. So they said, look, forget that. You can opt in to just figure out what the RMD is for the total amount of the account. That's good news for people, less they have to take out. Another thing here is pushing back the required minimum beginning date age starting next year to age 73. And then out in 2023, looks like they mean to be 75. There's a little bit of a drafting error in the bill. Might not get fixed before it passes, might get fixed later on. They also removed required minimum distributions from Roth accounts. So think 401k and 403b, remove them pre-death. Once you die, we are subject to required minimum distributions from Roth accounts. Roth IRAs were not. So this kind of even the playing field from a Roth 401k to a Roth IRA. Reduction in the RMD penalty tax. So a missed RMD penalty used to be 50% of the missed RMD. This will bring that penalty tax down to 25% and only 10% if it's timely corrected and filed and fixed. So bringing that down significantly. Contribution changes. A couple different things here. The IRA catch-up provisions, age 50 and after, you can add an additional $1,000. They're going to index that $1,000 for inflation now. There's a special provision here from age 60 to 63, so 4 years, where you can do an additional catch-up contribution starting in a couple years now, 2025. And that's going to be either $10,000 or 50% more than the traditional catch-up, looking like it's going to be about $11,250, maybe something like that in 2025, but only for those 4 years. Otherwise, you're back to the normal catch-up provision there, which in 2023, post age 50, is $7,500. They also increased multiple aspects of the simple IRA for employers to put more money into these plans, so additional savings opportunities there, higher contributions. College and loan, two big provisions here. Number one, 529 accounts being able to be rolled over to Roth for the beneficiary of the 529 to their own Roth IRA. There's a $35,000 lifetime limit on this rollover transfer capability. It is subject to the annual Roth IRA contribution limit, so the roughly $7,000 you can move a year. So it might take you multiple years to get that $3,500 over, and the 529 would have to be in existence for at least 15 years to qualify. The income limits on Roth contributions, however, do not qualify or impact this, but the annual contribution limits do. And then lastly, this finally finalized, right, the student loan repayment match. So if you have an employee that is paying their student loan debt down for qualified higher education expenses, the employer could choose to set up a qualified plan in which they match that payment to the student loan debt as if they were putting it in the 401k and match it just like they would any other matching provision. Retirement emergency funds, a lot going on here. So the first part here is creation of a pension-linked account. Up to $2,500 could go in here, and essentially protecting the principal of that with some reasonable rate of return. You could have up to 4 withdrawals a year, no penalty or fee. You think of this as a Roth-like account, but for emergencies being built into retirement plans. So a little bit of access point for this growth and for the principal. Then a 10% exception for emergency expenses up to $1,000. So this isn't a separate account. This could be from any of your accounts. And you can have up to $1,000 over a 3-year period that you can withdraw. You could repay it and then get the extra $1,000. And this is for family emergency expenses and unforeseeable expenses. There's 3 other ones I'll put in the emergency access piece. So down here, 10% penalty exception for those who are terminally ill. No dollar cap on this one. So if you become terminally ill, pre-age 59 and a half, can withdraw money without the 10% penalty. There's also a 10% penalty tax exception for domestic abuse survivors up to $10,000. And then a $22,000 federal disaster 10% relief piece here too, where that income would be spread out over 3 years. You could repay it in that or the domestic abuse situation and get the taxes you paid back too, but no 10% penalty tax in those situations. Next one here is 2 big annuity changes on qualified longevity annuity contracts. Number 1, no 25% cap anymore on QLACs, and the $125,000 limit on premiums moves up to $200,000. They also allowed for some spousal benefit riders here and described in some cases what happens in the case of divorce. Also, lifetime income benefits will be allowed on certain annuities inside of qualified plans and IRAs. In the past, it messed with the required minimum distribution rules if you had increasing payments over time, say a 1 or 2% increased payment. Now, this does allow for a steady payment increase, but less than 5% a year and still meet the RMD calculations, and also allows for a return of premium at death feature attached to these lifetime income benefits on annuities inside of plans and still meet the required minimum distribution rules. A couple charitable changes here. Number 1, QCDs, our qualified charitable distributions, can start after we reach the age of 70 and a half, send money directly from our IRA to a qualified charity. They now allowed for one $50,000 total one-time lifetime gift to a CGA, a charitable gift annuity, or a charitable trust, being a charitable remainder annuity trust or a charitable remainder unit trust. A CRUT is going to be the most likely use of this because we can fund CRUTs over time, where charitable gift annuities and CRATs, typically this is a one-time funding. It's going to be a little hard to time those up with the age 70 and a half and the $50,000, which is typically not enough to fund a good CGA or CRAT by itself. Could be a partial funding mechanism, but more likely to be used with CRUTs. Lastly here, the QCD $100,000 annual limit that you can send is now going to be inflation adjusted. Roth changes. Whew. So we have 3 main Roth changes here. First one, probably the simplest one, right? Simple plans and SEP IRAs now will allow for Roth accounts. So the employee could pick that, designate the money going in there to a Roth account. Number 2, matching So employer matches your contributions. Now also the employer can allow for the employee to pick a Roth matching election on that money. Now lastly, this one will be forced that catch-up contributions to Roth accounts starting in 2024 catch-up contributions starting in 2024 will have to go to a Roth account. That is if somebody has more than $145,000 of income the previous year. That is an index number, so people with $100,000 of income a year can still pick their catch-up contributions to say go to tax deferred, but everybody else will be moved to Roth. It's most likely that people meeting catch-up contributions will pass that limit, because that means you're doing over $22,500 already into a salary deferral plus an additional catch-up. Most of those people are high income earners, so most people will end up in Roth for catch-up contributions here in the future, which is a tax revenue generator according to the bill. 3 additional pieces here. There is a requirement to create a national lost and found registry for retirement accounts so people can find that there is no 10% penalty for long-term care premiums that essentially are paid for up to $2,500 a year from a qualified plan. So you can take the money out, pay ordinary income, and then pay long-term care premiums and not be subject to a 10% penalty. And lastly, a requirement for the government to standardize the rollover forms for IRAs and qualified plans by 2025. Whew, that was a lot in about 12 minutes. So this is the Secure Act 2.0, part of the omnibus bill here that is passing right at the end of 2022. This bill is a lot more about retirement security than the original Secure Act 1.0. This has now become called the Secure 2.0 Act, where it was kind of loosely referred to that for a while, but we said it so many times, Congress just said, forget it, we're going to name it that anyway. The first bill was much more of a kind of a stealth tax bill. The 10-year change to RMDs for inherited accounts, much more about raising tax revenue. This bill really is more about retirement security. Super interesting to see it pass. I know that was a lot of information in about 12 minutes. Again, I'm Jamie Hopkins, managing partner of Wealth Solutions here at Carson Group. Feel free to reach out to us. We'll be putting more content out as this bill progresses on, gets signed into law, and starts being implemented really over the next decade, as we have provisions that don't kick in all the way to 2033. Expect some drafting errors and confusion in this bill. With a bill with this many pages, this many provisions, there are going to be errors. The government will do regulations afterwards and likely a corrections bill to fix some of these issues. So again, don't panic off of every little piece in here, but a lot of things coming at you. Everybody have a great holiday season. Stay safe, stay healthy. Again, Jamie Hopkins here. Follow us at carsongroup.com or reach out to me, jamiehopkins.com, or follow me on Twitter at Retirement Risks. Thank you, everyone.